Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built on unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to session 20 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for our 20th session on understanding tax implications on mutual funds. So let us now begin with our learning session today. In our previous session, we told you how you can avail of tax saving benefits by investing in mutual funds. But do you know the gains you make from your investment in mutual funds may be taxable? So whenever you select any form of investment, make sure that you are well versed with the taxation part of it too. Knowing the tax implication will help you understand the net returns after adjusting for tax you will enjoy on your investments. So let us see what are the tax implications of investing in mutual funds. But before that, let us see what are the factors determining tax status of mutual funds. First, you need to know the type of mutual fund you are investing in, whether it qualifies under equity mutual fund or debt mutual fund. Equity funds. You see, any fund holding over 65% of its assets in equity shares in domestic companies qualifies as an equity-oriented fund from a taxation perspective. Non-equity funds are those which hold less than 65% of their portfolio in equities and equity-related instruments. They can be debt funds, debt-oriented hybrid funds, or liquid and money market mutual funds. Then the next is the type of income also determines the tax status of mutual funds. In mutual funds, you may earn income in the form of dividends and or capital gains. Dividends. While investing in mutual funds, if you have opted for the dividend option and are in the receipt of dividend income from mutual fund scheme, it is tax-free in your hands as an investor. Capital gains. It is the profit that you make from an investment in a mutual fund scheme. But the period of holding and capital gains are important to determine the capital gain tax on your mutual funds. So your capital gains could either be long-term capital gain or short-term capital gain. Long-term capital gain. In mutual funds, any holding over a period of 1 year is considered as long-term. So if you make a gain on your investment in a mutual fund scheme that you have held for over 1 year, it will be classified as long-term capital gain. Short-term capital gain. If your holding in a mutual fund scheme is less than 1 year, that is, if you withdraw your investment in a mutual fund scheme before 1 year, after making a profit, then the profit will be considered as short-term capital gain. Then comes the tax status. Your tax status is also important to determine the tax implication on your investment in a mutual fund. So you may be investing as a resident individual or a Hindu undivided family or a partnership firm or association of persons or a body of individual, whether incorporated or not, or you may be investing as a domestic company. In case your residential status is NRI, then your residential status may have an impact on the tax implication of your mutual fund investment, and we'll explain to you how. Tax implication on equity mutual fund investments. In case you have opted for the dividend option while investing in an equity-oriented mutual fund, it is noteworthy that the dividend received from an equity-oriented scheme is exempt from tax, as dividend income is tax-free in the hands of the investor. Moreover, there is no dividend distribution tax borne by the mutual fund house on the dividend distributed by them in case of equity mutual funds. So for capital gains on equity mutual funds, short-term capital gain, long-term capital gain and TDS for various types of investors is explained here. As you could see that there is no long-term capital gains tax on equity mutual fund schemes. So by investing in equity mutual fund schemes for the long term, that is for a period of more than 12 months, you will not be liable to pay any long-term capital gains tax. But in case if you have booked profits in the short term, that is within a period of less than 12 months, you will be liable to pay short-term capital gains tax on equity-oriented mutual funds at the rate of 15%. Securities transaction tax at the rate of 0.025% will be deducted on equity funds at the time of redemption, that is sale of units or switch to other schemes. Apart from this, a surcharge at the rate of 10% is levied in case you are an individual investor or an HUF whose income exceeds Rs 1 crore. Also, surcharge at the rate of 5% is levied for domestic corporate unit holders whose income exceeds Rs 1 crore but is less than Rs 10 crore. In case where the income exceeds Rs 10 crore, a surcharge is levied at the rate of 10%. Tax implication on debt mutual fund investments. When you receive dividend income, the dividend distribution tax on liquid and money market schemes, the dividend distribution tax on debt schemes other than infrastructure debt funds in case of various types of investors. As seen here in the table, dividend income received is exempt from tax in case of debt mutual fund schemes as well. But there's a dividend distribution tax that is deducted by the debt mutual fund scheme while they distribute dividends. It is at the rate of 25% plus 10% surcharge and 3% cess for individuals and 30% plus 10% surcharge and 3% cess for corporates. For capital gains tax on non-equity, that is debt mutual fund schemes, short-term capital gains tax, long-term capital gains tax and TDS for various types of investors. Here in this table you can see that long-term capital gains on debt mutual fund schemes are taxable at the rate of 10% without indexation or 20% with indexation, whichever is lower. And in case if you have booked profits in the short term, that is within a period of less than 12 months, you will be liable to pay short-term capital gains tax on debt mutual funds at the rate of 30% or as per your tax slab. And in case you are an NRI, then you should note that tax deduction at source on capital gains will take place for NRIs after providing for indexation benefit if applicable. Now before we end our learning session today, here are some points you need to remember. Points to remember. Mutual fund schemes holding at least 65% of its assets in equity shares in domestic companies enjoy equity-oriented tax status, while mutual fund schemes holding less than 65% of its assets in equities are classified as non-equity scheme from a taxation angle. Profits from schemes held for more than 1 year attract long-term capital gains tax. Profits earned from scheme held for less than 1 year is liable for short-term capital gains tax. There is no long-term capital gains tax on equity-oriented mutual fund schemes. Long-term capital gains on debt mutual fund schemes is taxable at the rate of 10% without indexation and 20% with indexation, whichever is lower. Dividend distribution tax is deducted by the fund house at applicable rates while distributing dividend income on debt mutual fund schemes. And last but not the least, TDS is applicable on gains made by NRIs. So to end our learning exercise today, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.